All right. Good morning, everybody. Welcome. Happy President's Day today. We'll try to figure out this market together, look at a few strategies, get you ready for tomorrow a little bit. Well, let's jump in here a little bit. First of all, just a little perspective. When we talk option strategies, I kind of look at things from a complete option portfolio. Any strategy that you guys think of, or maybe any strategy that you've done this year or thinking of doing, should fall into one of these categories. So I always try to run this like a business, right? Obviously, as you learn it, it's a craft, but you want to run it as a business. So where do these different pieces fall in, right? These different trades that you guys do. And so running it like a business, okay, if you have three parts of this complete options portfolio, then you can get better at, okay, depending on market conditions, how much do I allocate in each part, or maybe one part I don't trade or whatever. But I would say the first part would be a long portfolio. And I would guess most of you, I would bet all of you have something in the long portfolio. And defining the long portfolio is more that part of your portfolio that has more of a long-term bullish, right? Covered right, cash secured put, long stock, long leaps, long mutual funds, put credit spreads, long diagonals, that's like a covered right substitute. And that's an intentional part of your portfolio that you would do on a regular basis. And how many of you, is there any one of you that does not have something in a long portfolio? Is there any of you who do not have anything in a long portfolio? Long stock, long mutual fund, long diagonal, covered right, cash secured put. Oh, so Scott, you have nothing. Okay, no problem with that, but I would say most will have something, right? And that's more would be in your retirement account, right? Oh, Sam says all in real estate. Well, Sam, that's a good idea right now, isn't it? That's great. But that's a long portfolio. And then, so, if you had a 100K portfolio, most of the time, we might have 30 to 40% in a long portfolio. But some students, just like Sam said, some may not want to have anything in a long portfolio. They might put it all, I call the next part income portfolio. And I mean, it's all would technically, even long portfolio would be income, but I just call it different names. Income portfolio would be more range-bound trades based on probabilities and time decay. Iron condors, butterflies, calendars, double diagonals, certain put credit spreads, but that would be range-bound. And I usually would be, depending on market conditions, and we're going to get into that in a second, it could be 40%, could be 40 to 50. And we'll get into that in a second. How many of you do trades from the income portfolio? Some type of iron condor or butterfly or calendar or something like that. The last part of the portfolio would be spec. And spec starts out with, I have an opinion. It could be based on fundamentals, technicals, late night pizza, whatever, right? Spec could be buy calls, buy puts, buy vertical debit spreads. If you're bearish, buy it in the puts. If you're bullish, buy it in the calls. Directional butterflies and calendars, ratio back spreads, many ways to play spec part of a portfolio, right? So you have three parts of the portfolio. Now, everything you guys do falls into this, and we have different criteria when we might play each part of the portfolio. So those are three. Now, if we look at the current market now, today, SPX is 43.48. So as we speak today, we're down about 10%, right? Maybe 9.8% or, whatever it is today. But off the January 4 highs, we're down 10%, right? VIX, with this correction, is at 27.75. How many think that's high or low, given that we're down 10% in the market? How many just think, as you look at VIX and your belly button, you think that's high or low? Yeah, the best answer. You know what the best answer is? Whoever said just right, right? I'm a big believer in the market. The market, it's right where it should be, right? But my comment would be, if you said to me, hey, Dan, let's say I was in, I was in a part of the world, I don't know what part of that world would be, but if I'm in the part of the world where, I'm in the rainforest or something and wherever, and I don't have access to the market for 3 months, and you told me, look, we're down 10% in the market and VIX is 27.75, I would say, that seems low. I would think with a 10% correction, we might be closer to 35. What do you think is the reason? Let me ask you a question. When you're in Chicago and you have the first big snow of the year after 8 months of no snow, and you're kind of forgetting what snow looks like, the first snow of the year, there's more excitement. You're on it. The snow plows. Let's go. But let me ask you a question. And you might not go out, right, as much, and it's a bigger deal. But after you've had about 3 months of snow, do you really give a hoot anymore? Does it really affect your day-to-day? After you've had 3 months of it and you're used to it, does it really affect what you do on a day-to-day basis? No. Here's the point. How many weeks ago did this correction start? January 4th was the highs. Is that 1 week ago? Is that 2 weeks ago? Is that 3 weeks ago? Is that 4 weeks ago? Is that 5 weeks ago? Tell me. That's 7 weeks ago. Agree? This correction, 10% correction that is lingering, has taken a while. So you know what the market's saying? I'm getting used to it. It is what it is. So the longer we stay in this down move or 10% correction, the market gets used to it, right? Right? The market gets used to it, right? Yeah, and George says mostly high, multiple no. Yeah, but what I'm saying, the reason the VIX, to me, might be a little low, given we're down 10%, is, normally corrections, sometimes if the correction happened in a 2-week period, it'd be different. Let me give you an instance. Let's check real quick, right? So at January 4th, we went down about 10%. My guess is when we were down here, which is about where we are now, VIX was higher, right? So let's look. So let's go look around. You can see here, I've got implied volatility, which is basically the same thing as VIX, but you can see here, let's bring VIX up. So if we go to like January 27th, January 28th, so January 27th, VIX closed at, 30.5. January 28th, VIX closed at, 27. January 25th, VIX closed at 31. So we get up to maybe 31, right? And so anyways, the bottom line is the longer we kind of hang, because we've already been in the 7th or 8th week, it's not as big a deal, right? I mean, that's what I think it is. Now, when you evaluate what strategies to do here, all right, what strategies for you guys are working right now over the last month or so, since this correction? What strategies are working? This is a different environment. This is a 1-year price chart in SPX. Most of it is pretty, for the most part, tame, slowly trending up. This is a 50-day moving average. This is a 200-day moving average. But, the last 7 weeks have been much more turbulence. DT's broken wing butterflies, broken wing iron condors, double diagonals, short call spreads, call credit spreads. So, different thing, long puts. Okay. So for the long portfolio, how has this been over the last 7 weeks? Good or bad? For the long portfolio, well, if long portfolio is bullish stuff, it can't be doing really well, right? Unless you hedged against them, that would cut some of the losses, but that's not so good. So we'll say that's bad. Now, for the range-bound part of the portfolio, would everybody agree that's not an ideal range-bound scenario? I'm not saying it's absolutely horrible, but would everybody agree that's not, since January 4th, not an ideal range-bound scenario? Agree, disagree? So how do you navigate when there's a lot of turbulence like this? When you're in again, I'm not a pilot, but when you're in an airplane, I remember when we'd be a lot of turbulence, always seemed like we were going from Chicago when I'd be going to California for a seminar, always seemed like there'd be turbulence when we get through that Denver area. I don't know, or the mountains. But, they'd always say, the pilot would say, we're going to try to find an altitude where you guys can, sit there and drink your Cokes and eat without having to sit the stewardesses down. But so when we get in our community, Sheridan community, when we get a period like this for range-bound trades, there's some things we do. You say, what? We go smaller size, right? Should we, when we have this for range-bound trades, just put our nose down and say, what would you think about a pilot that said, turbulence, let's go right into it, shove it right in its nose? Would you guys be impressed with the pilot if he did that? No, that wouldn't be so good, would it be? So during here, we go smaller size. How do we get through turbulence? Smaller size, depending, right? Smaller size during this, if we kept going down, you might not do anything, but smaller size, further out duration, and generally short Vega. That's been our formula for the last 7 weeks, right? But even that, it's been difficult, right? Because experience level, we're a little more used to it. We've been doing this for a long time, but like we have a 3K class, a plan to make 3K on 25K, and I'm dragging, over 200 people through this on live trades. Many of them are newer. Do you think they can, since they're doing the trades, do you think it's easy for them to manage the airplane when you're going through turbulence? No. So I've been even much more cautious, because what's been the big problem? Let me see if you guys can get it. What do you think for people that really haven't done much of range-bound trades, what do you think is the biggest problem the last 7 weeks? Here's the biggest problem, which concerns me for newer people. It's not the movement, because if you go for enough duration, 30, 40, 50 days out, you can be okay. So, but I think execution becomes a big problem. And if you're doing a couple adjustments or have to do something and you're giving up 50 to 60 cents in slippage, right? And I just, I think that's really one of the big problems, because, if you look at the mid prices and some spreads as the markets over the last 6-7 weeks, it's all over there. And if you're not patient, maybe a little more experienced with it, you give away a lot of money, because let's face it, if I said to you guys, how many of you have a lot of experience trading on the downside? What would you say? How many of you have a lot of experience trading the downside? Here would be my answer. If you said, the people watching this webinar, do you think they have a lot of experience trading the downside? I say, they don't. I know they don't. You say, Dan, why do you know they don't? Well, because I know what a chart of SPXs look like for the last 7-8 years. And which way is SPX? If we bring up a chart of SPX for the last, all right, so let's bring up a chart. This is why I'm so smart, because I can look at a chart and I can see what it tells us, right? But I look at SPX and I say, all right, let's look at the last 10 years. Wow. All right. So if you said to me, hey, Dan, why don't we have a lot of experience? How can you say I don't have a lot of experience trading downside? Well, this is what SPX is telling me. And it says we've mostly been going up. And so the reality is, I know, because I've had the privilege of getting whacked more than you guys, just because I've been trading longer than most of you. But if you look here, trading the upside is much different than trading the downside, right? I think it's much more difficult trading the downside because of the execution and slippage and other things. So I'm less excited about getting newer students in because, or have them do less adjustments. Now, let's go back. So I didn't mean to go so long today. I was just going to go a few things, but let me get back here and go over a few strategies. So what are a few things that we've been doing in the market that I've liked over the last, overall, what I still think are good, if you said to me, good opportunities in the market. First, let me address the Russia thing. France says you seem to be very against buying puts. No, Fran, honestly, just the other way, we are big buyers of puts. Usually in form of adjustments at certain times, and we have certain criteria for buying puts. But no, I'm a huge proponent of buying puts at the right time, in the right manner, in the right duration. Yes. So we are. One of my fighting slogans for years has always been, buy a stinking put, right? So, but again, I think like anything else, there's a certain way to buy them. And, Kevin says, well, sell far out of the money call credit spreads instead of buying puts. Again, it all depends on what you're doing, right? If you're doing for range bound trades, there's certain times if we're going down and we're going down fast, right, that you'd buy a put. For example, we've got quite a few students in the COVID correction when it first started going down. If you look at the COVID correction real quick here, isn't that interesting? The COVID, the correction, it gets its own name, the COVID correction. If you look at the COVID correction here, did any of us know as we were coming into January, February of 2020, did any of you have an idea we were going to go down 30%? Yes or no? Just so you know, if you do say yes, I don't believe you anyways. But no, Who the heck knew? I was in, I think, Huntington Beach, February, right around this time. I had no idea. But let me ask you, how did a lot of people, including our community, avoid 98% of this down move for our range-bound trades? How do we avoid it? Just to make a few comments. Well, if you look at here, it's like we're going up to Niagara Falls, right? None of us knew the 30%. But again, if you go to the ocean in Miami Beach, and this will be my last thing to bring up about criteria, and then we'll get into spreads, but this is important. If you go to Miami Beach, none of you know what the weather's, you go to the beach, but if you can see sharks, you can see 10-foot waves, you could see lightning, and then you can make a decision, should you stay out of the water? Hopefully the answer is yes. Well, same thing here. Why did we get out of the market quickly around here? Well, if you look very early in, first day or two of this COVID correction, we went down under the 50-day moving average. So start going down under the moving averages, not soon after the 200-day moving average. We got out of our normal VIX range of 16 to 26. We blew past that. We look at this average true range, went through the sky. That just tells you the difference between the highs and the lows in SPX. Many different indicators, but right away, we're like, all right, everybody get to the water or get to the beach. But the problem is, and this relates to the put question, when we buy puts, it's easy to say at about this point, all the indicators get back to the beach. You agree? So that was, and it's usually pretty clear on a lot of that. But what if you have a trade on? What if you have a range-bound trade on and you're in a massively turbulent period and we're going down? Should you trade it, right? Should you trade it the same way you normally do? Does a pilot fly the plane the same way in massive turbulence as when it's totally clear? Yes or no? I'm not even a pilot. If there's a pilot here, I hope I'm right? The bottom line is, what we say is, if you're in the market, it's more turbulent and we're going down and the execution's bad, you buy a put to hedge your deltas, to get your deltas flat. And did you know, for our students who bought puts against their Iron Condor, Calendar, whatever, it was their best trade of the year. Best trade of the year, right? As the market went down, the puts made a fortune. But the key is, right, you got to be careful when you buy puts, how you buy puts. How many of you think when you buy puts to hedge a trade, how many of you go 1 week out, 2 weeks out, a month out? What do you guys do to hedge? If you're going to buy a put against a position that's getting in trouble, how far out do you buy your put? Yeah, generally when I buy a put, I will buy it, even though it's more expensive, I will buy it 30 days further out than whatever my trade is. If I have a butterfly or an iron condor, or whatever the trade is, and it's 30, 40 days out, I'll buy my put 30 days further out than my expiration. You say, well, Dan, it costs more. Yes, it does cost more, but it's going to affect the theta less. I can stay in the trade a little bit longer. And there's reasons for that. You can say, well, a put a 1 week out will be cheaper. Yeah, but it's not going to help you, except for maybe a few hours. Anyways, so let's look at a few trades today. So one of the trades I'm looking at, as far as the market, I don't know. Does any of you know if we're going to be going to war this week? Does anybody know? I don't know, right? Who knows? I mean, my guess is no, right? I think this is just a whole, but I don't know, all right? I don't put much value in my opinion. But I look at, regardless whether we had war or whatever, we're still down 10% in the market. So here's the problem. Are you more concerned about the downside or upside right now? What's your opinion? Who's more concerned about the downside or the upside? Are you more concerned about the downside or upside? If you asked me, right, both. Say why? Right now, we're 450 points off the highs on January 4th, 7 weeks ago, 48.18. 450 points. So if the things start resolving and we rally up, are we going to go up 10 points in SPX a day till we get back up? Yes or no? Are we going to go up 10 points in a row? Are we going to go up? Here's my point. We're going to have 100-point up move, 125-point up move, right? If we go down, we get a 100-point. So it looks like more to me. Now, from a technical, you could look at this and say consolidation or whatever it is. But either way, without being a chartist, which I'm not, you ready for this good English vernacular? We ain't sitting here, probably, unless this posturing with Russia, they just, go on and on and on for another week. And, it could, I guess. But eventually, once there's good news or bad, we're going to go up 100, 150. You're going to start recovering or go down 150. So it's a little more turbulent. So that's why I'm not a big proponent. So in other words, how many people also think with the VIX is high, this is a good time to sell options? How many think this is a good time to sell options? But let's be honest. Do I believe volatility will go back, kind of revert to the mean? Yeah, but if you have an iron condor on, all right, which I'll show an example, you get lots of room and beautiful. But if we go up 150 points, we're not going to lose any money probably, right? But what we make on volatility coming down will be offset by price movement. Does that make sense? So it's not as clear as you think. All right, anyways. So in this environment for the range bound, the first thing I would look at, all right, let's take a look at this, right? Here's a put vertical credit spread in SPX. Let's take a look at this. Here's a put vertical credit spread. Who's ever done put vertical credit spreads in SPX? So here's where it is. This is March 25. So, what is that? 34 days out, March 25th. So March 25th is what, 30 days out, 32 days out. So here's what it is. For a 32-day put credit spread, we're 32 days out. We're selling the 40-30 puts, and we're buying the 40-20s. And this is all with VIX at, where's VIX at? VIX is at 27.75. How many would do something like this? The credit is, say, $1.55. Let's call it $1.50. And so your margin or risk is $850. How many would consider something like this? Yes or no? Again, somebody said, I don't know if I would sell put. Am I selling puts here? Selling puts gives an indication of what? Am I selling puts? If I say I'm only selling puts, is that a correct statement? This guy's saying, hey, what about me? Right? This isn't selling puts. Now, I just want to point out something. If you said to me, Dan, would you do an iron condor or a put credit spread right now? And again, I have no opinion on the market. I would do a put credit spread. Dan, if you could do an iron condor or a put credit spread, why wouldn't you do an iron condor? You get 2 credits. Here's a put credit spread. Let me tell you why. When you do put credit spreads, especially in the SPX, when VIX goes higher and higher and higher, right? Number one, there's 3 benefits. Let's see if you guys knew them. 3 benefits to doing put credit spreads when the VIX is higher. Number one, the credit is bigger than if we did it when VIX was in 20 or 19 vol environments. Does everybody understand that? on put credit spreads, when the VIX is much higher than normal, you're getting a bigger credit. Yes or no? How many knew that or do know that? Okay, number two. The other thing that happens when you get a higher VIX as opposed to the normal range, 16 to 20 to 22 to 23 distance. So this is a 32-day trade. Our short put is, this is an expiration graph, is at 40.30. So we're getting distance to where we currently are, over 310 points. On a 32-day credit spread, when VIX is lower, are we getting 310, 320 points? It does matter. Well, so it does matter. You are getting a lot more room. You can handle a lot more room on these things. We generally, on put credit spreads, it's a different discussion. We will, well, let's just finish this thought. And then the third thing is, when you're doing a put credit spread, how many think it's a directional trade? Would consider this trade directional? Really directional. So I'm selling a 20 delta put to pick my short strike, and I'm buying a long put 20 points against it. I'm picking my short strike on this put credit spread. I'm going 32 days out, selling a 20 delta put, buying a put 20 points underneath it. But the point is, normally a put credit spread, it is directional. And this is directional. We have no risk on the upside. We only make money. But when you have a credit spread and the VIX, the volatilities go higher and higher, what it does is it reduces your long delta exposure. So I'm only 0.59 delta long, right? I'm a half a delta long, right? How many don't know what delta means? How many are not familiar with the word delta? How many are not familiar with the word delta? Delta, think in terms of stock equivalent. If you're long one delta, think of it as one share of stock. If you're long 50 deltas, think of 50 shares of stock. So if you're long one delta, it goes up $1, you make $1. If you're long one delta, it goes down $1, you lose $1. This is literally almost half a delta, like half a share of stock. That's not a lot of exposure. In other words, if VIX were 16 and 17, and I did a put credit spread where I'm selling a way out of the money put at a 20 delta, this spread would be like 2 deltas long or something. So the point is, if I'm almost neutral, right? So do we all agree that the market could go up 100 and 200 points or down 200, right? Everybody agrees, yes? We could move 100 or 200 points. If I just do the put credit spread and we go up 100 or 200 points, what's going to happen to this credit? This is a 10 wide credit spread. What's going to happen if we go scorching up 100 or 200 points? What's going to happen to this trade? That credit will decrease. I'll probably get a 10 to 12% profit in one day. If we go down 10%, well, 100 points, right? We'll have to manage it. But again, this is almost delta neutral, right? So my point is, with an iron condor, yes, I get 2 credits, but either way we go, I'm not going to make much initially, right? I mean, I'm not saying if I stay in an iron condor over a period of time, I could still make money. I still think I would. I think it's a good trade. But because I'm close to delta neutral, I'd rather just put the put side on. If we go down, I can adjust it. I can manage it. Does that make sense a little bit? Again, we could spend hours on this. I don't, but I'm just trying to at least give some thinking, right? I mean, if you're newer, Kevin says, would I ever sell strangles? We do sell strangles, but I have a short strangle iron condor we teach, and it works really well. But here's the thing. I have no problem with short strangles. I always would buy a hedge. And we have, I think, a very effective strategy we use selling strangles. But what's the problem with short strangles? What's the problem? The name of the game, what we're trying to achieve is a good yield. Agree? Isn't that what you guys try to achieve with your money, a good yield? The problem with short strangles is the yield stinks because they're going to have you put up 2 cows, a horse, 2 of your children, 2 of your cars, and your mother-in-law, right, to put the stinking trade on. So why wouldn't you go grab a hedge, right? Buy a put 100 points out of the money to hedge. It makes no sense to me. Now, the put credit spread, I don't have time to get into management. We have different methodologies with the put credit spreads. For some who don't want to adjust, we have a simple methodology with no adjustment. For those who want to adjust, we have adjustment. If you go to our website, I think I did a deep dive, kind of a 3-hour webinar. It's on demand, all on put credit spreads in the SPX that you could look at. That's available. What I would recommend, but anyways, I'm running out of time, but let me extend that. If we go to whereas if you do an iron condor, now iron condor, you're getting 2 credits, right? An iron condor, instead of getting a credit of just $1.50, right, on the puts, you're getting $1.50 plus you're getting another $1.25 on the calls. So your margin would be 1,000 minus both of your credits, right? What would that be? So then it'd be 6, let's see, credits of 275. So your margin would be $725. That's a heck of a yield, right? Right? Your margin would be this, and you're bringing in credits of 275. And that's pretty good. Versus if you just do the put credit spread, you're bringing in a credit of 150 and you have margin on 850 because your risk in a 10-point spread is 10 points, $1,000. And that's what we're doing, $1,000 credit spread. But the iron condor, I think this trade would work out, right? I think this trade would work out, right? In this particular iron condor, I'm selling a 20 delta put to choose my short strike of 40.30. I'm using a 10 delta call to pick my short strike of 46.60. And this is all with SPX at 43.48. So you're getting over 310 points to the upside, 310 points or so to the downside. And again, I'm actually going to probably by the end of this week or next week, I'll have a new on-demand video on iron condors I've been working on. So I'm thinking more like this, but you can see equidistant just means it's a little more balanced, same distance relatively, upside and downside. And I think that would work well in this environment. It gives you a lot of stinking room. But if I'm looking to get something off in the next week or two, I've got a better chance to put credit spread. I have no risk on the upside, right? So again, but the bottom line is we're in a volatile environment. You are getting some benefit, but let's face it, because of the uncertainty in the market, is there any distance I could give you from the short strikes that you'd be happy with? When you're concerned like you are with the market, right? If someone said, I'll give you a credit spread with 100 points room, 200 points room, 300 points room, 400, are you ever going to be happy? Yes or no? Is anything ever going to make you comfortable? No. France says futures down 43 right now, buying puts. No, I buy puts if I needed to for a position. Again, I don't trade. I usually trade during normal market hours. Anyways, so a couple ideas today. I hope I was going to go over some more stuff. I would recommend, if you want to, I'll leave you with this. We've been doing a 3K class, plan to make 3K and 25K. We started in June. We've gone June, July, August, September, October. We combined November, December. We did January. We'll be starting another one. We were going to start it this coming Tuesday, but we have to go out of town. We have some family health problems out of town that we are going to go visit about that, some family. So we're going to postpone the class from this Tuesday to next Tuesday, which start, I believe, March 1st. But I think that would give you a good opportunity, every month except for January. We came pretty close to our target. And starting in April, we're going to scale up this thing. We're going to go, April will go, instead of 3K on 25, we'll go 6K on 50. And every 3 months, we'll escalate that. Intentionally, we're taking newer people with no experience doing this stuff, right? And they're doing well. We're way up on this since June. It's just January, I purposely, with a correction 10%, it's not good range, but we backed off more. Our indicators basically told us to back off. And I didn't want to watch, I'm more comfortable in this environment, but to put newer people through that aren't used to it, they're not going to do so well because they're going to get butchered with execution. We actually broke even in January, but every other month was maybe 8 to 12%. And it probably will continue like that. February, the next class, March, should be much better, depending on what the market. But I think it's a wonderful opportunity for you to join in and learn the business the right way, the craft. But we're holding your hand on every trade. And so I would encourage you to look into that. Do we trade binaries? No, I'm not saying they're bad at all. I think they're an interesting thing, but we don't, not because it's just, you can only trade so much, right? Dan, why 10% delta on calls and 20% delta on puts for the iron Condor? Why not same delta for both sides? If you go same delta both sides, that we would call that more same delta iron Condor. Interesting enough. I would do that if I was a little more bearish, because that's going to lean you a little more short. If you do a same delta iron Condor, instead of it being more balanced, right, you're going to get more room on the downside, less room on the upside. So right now, since we've already been down 10%, I'd want a little more balanced. Well, folks, have a wonderful day. Enjoy the rest of President's Day, and look forward to seeing you guys a week from Tuesday in the March 3K class. Thanks.